Google just reported earnings and the stock is down 7% in the after hours. I'm going to upload the video tomorrow. But many of you guys have asked me about an update on the stock. I haven't talked about it for a while. It's up a lot since I talked about it whenever we had the drama around ChatGPT, taking over Google. I talked about it a lot. So I owe you guys an update. I'm going to talk about earnings, let you know my opinion, let you know if I believe $192 is some kind of a generational buying opportunity on Google, or maybe it's a little bit overvalued and we should wait for a lower price. Okay, now for revenues, they did miss on revenues a little bit, a very slight miss. For earnings per share, they beat by 2 cents, which wasn't really bad at all. It was very good actually. In terms of the growth, they grew 12% year on year compared to more than 13% growth in the same quarter last year. The company's revenue growth, as well as growth from its search business, its YouTube ads business, its services unit, were all slower than compared to a year ago. And that was one of the reasons why, Google is going down, is because the growth is slowing down and the market is freaking out a little bit. Now for Google Cloud, it's actually looking much, much better. You look at the overall trend, it's trending in the right direction. It's looking much, much better. It's been profitable for a few quarters and profitability is ramping up. So everything is looking better. But the only problem is that in 2023, especially in Q4 of 2023, Google grew around 56% in earnings per share. I'm looking at earnings per share, but they grew a lot in 2023. Now, the fact that Google were able to grow 29% in 2024 compared to 56% last year in earnings per share, that was very impressive. So again, I believe it's some kind of an overreaction, but the company, the stock was just doing amazingly well last year and the business grew in general. Now it's going to slow down. That's just the way it is. It's not going to keep growing 56% forever or 14% revenue growth forever. Sometimes it's going to be a little bit slower. Sometimes it's going to be a little bit faster. But one of the main reasons why, the stock is going down so much is because of CapEx. And in this quarter, especially after DeepSeek, the market has been freaking out about higher CapEx for a lot of the big tech stocks. And Google plans to invest $75 billion in capital expenditures in 2025 as it continues to ramp up or expand on its artificial intelligence strategy. That's above the $58.8 billion that Wall Street expected. It's a massive, massive miss. They were expecting $58 billion, and Google is going to spend $75 billion, which is almost 50% of their expected operating income. Last year, they made $128 billion in 2024. They spent around $52 billion in CapEx. But this time, they're going to spend about 50% of cash from operation on capital expenditures. So that's massive. That's massive for Google. But I still believe that the management at Google is not dumb. They're not stupid. And I believe, they believe those investments are worth it for them to increase it to $75 billion. But we're going to find out. And this is the main reason why the stock is going down so much. Now, one thing about Google that I like is their exposure to many different things. You're not just getting Google, you're not just getting YouTube, you're not just getting Google Cloud, you're also getting a lot of the stuff within quantum computing, which they made massive advancement in quantum computing. And that alone in the future, if they spin off the company in the right market, it could be worth tens of billions of dollars. But they have Waymo, and Waymo, in my opinion alone, in the future, in the right market again, could be worth hundreds of billions of dollars if it was split up apart. And I believe this is what Google will ultimately do. And for Waymo, this is what the CEO said. He said a few words on Waymo, which made tremendous progress last year. Safety, serving more than 4 million passenger trips. It is now averaging over 150,000 trips each week and growing. Looking ahead, Waymo will be expanding its network and operations partnerships to open up in new markets, including Austin, Atlanta this year, and Miami next year. In the coming weeks, Waymo One vehicles will arrive in Tokyo for their first international road trip. And Waymo and Tesla, they're the leaders in it, and Waymo is commercializing it. And again, I believe the company alone in the future could be very, very profitable, and it could be worth hundreds of billions of dollars in the right market if it was spin off from Google. But Google's balance sheet is still amazing. It was over $95 billion in cash and cash equivalent. They're still buying back a lot of stock. And every single quarter, they reduce shares outstanding. They've been very disciplined with the shares outstanding. It wasn't really the case before. Before, they were mainly flat for so many years. But now they're returning value to shareholders through buybacks. And they even have a small dividend, I believe. So it's been getting better for Google. And the growth has definitely been slowing down. And you can clearly see it from, buybacks and dividends. Whenever a company does a lot of buybacks and dividends, that normally means that maybe they don't see that much places where they could invest for growth. Like Amazon is still not buying back stock, is still not doing dividends, and I own Amazon, and they see a lot of potential. So there's nothing wrong with doing buybacks and dividends, but again, I prefer if the company reinvests most of its cash flow well into the company and not just distribute it to shareholders. That's just my opinion. But for Google right now, it's not trading at 23 times earnings. It's actually trading at 21.5 times earnings, which is very cheap. But the only problem is that Google has always been cheap. So the mean PE is 23 times. It traded as high as 30, almost 35 times, and as low as 16 times. It should be trading much, much higher. But it never goes much, much higher. And the mean over the last 10 years was 23.8 times. And this is with Google growing much, much more than it is growing at right now. Now, for the growth of earnings per share, it's expected to be 12% for 2025. Again, last year it was 37%. It's not going to be 37% forever. So it's expected to go to 12%, then around 14%, 15%, and ramp up to 17%. So that's very, very interesting. Now, for my valuation model, I took two case scenarios on Google. The first one is if Google continues growing earnings on an average of 13%. So 13% earnings per share growth, which I believe is fair. And I use the mean PE ratio of 23 times earnings, which I believe is also on the low end, but I believe it's somewhat fair. So I use this as for the first one. The second one was 15% earnings per share growth for the next 5 years. And then I put up, and I use this one again, 798. So I put in 798 for the next 5 years, 13%. This is the same thing, 798, 5 years, and I put in 15%. Okay. Now the lower end of my fair value or the worst case scenario is if I get 1470, okay, and I time it by 23 times earnings, I get $338 per share for Google. The current price is around 192, which is around 76% on the upside over the next 5 years with a company like Google. But for me personally, it's not bad. But for me, I like to get it double every 5 years or a 15% CAGR for the next 5 years. This is the minimum I look for. So if I want to double my money with this valuation model with a company like Google, I would have to pay no more than $169 per share or pretty close to 170. So if Google goes to 170 with this case scenario, you could get a double in the next 5 years or a 15% CAGR, which is double the long-term return of 7 to 8% for the S&P 500. Now, on the best case scenario, and maybe this is still not the best case scenario because the PE ratio could be a little bit higher, but I'm using again, the total, which was around here is around 1650, and we get $16.05, and I time it by 23 times earnings, I get $369 per share. If I divide it by the current share of $192, I would get around 92% on the upside with an amazing company like Google over the next 5 years, which is not bad at all for the company. But again, if I'm looking to double my money with Google over the next 5 years, I would have to pay no more than $184 per share. So even if I use my best case scenario within good estimates, the mean PE ratio, no crazy multiple expansion, 15% earnings per share, which is on the high end, using all that stuff, I still get $184.50 for my fair value for me to get it double. So for me here, Google is not really bad, especially if you're a long-term investor, you like the company. That's not really bad at all. I'm just being honest. But for me personally, I wouldn't buy Google over $185. If it goes below 185, it starts getting interesting. Then I start looking into it. Maybe I open a small position, dollar cost average down. But at this price, for me personally, I'm seeing better value in the market. And that's just my honest opinion on Google. I share everything I do in my own group. This is the link if you're interested. Thank you very much for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.